Welcome to the Business Summer Series. I'm Alicia Barry. Coming up, all our best stories on mining and resources, including a greener future. Australian coal communities reinvent themselves as the world turns to a new generation of power.
It's real. You know, those boilers blew up, people were retrenched. It's real.
And total control. Fears over China's market monopoly in the race for rare earths.
Of late, there's been a number of threats made that it might cut off supply to the United States in the future.
Calls for a price on carbon grow as countries pushed hard to consign coal to history at the UN Climate Conference in Glasgow. Increasingly, coal assets are being stranded, and Australian communities reliant on the black rock are already preparing for a greener, different future, as Daniel Ziffer reports.
Brown coal, like this pit in Victoria, has powered Australia for a century. ASX-listed Aussie Broadband sits on the edge of Morwell's open cut. Inside,
yeah, fair enough.
Claire Morrissey helps manage over 200 employees.
Seeing Dad working at the power station all his life, I'm really proud of that because what the power stations around here have done is propelled Victoria's innovation.
Just a kilometre away, the site of the former Hazelwood power station, where her father John Morrissey worked as an engineer for 35 years.
I grew up out of town in Traralgon South, and I guess always part of the community. It's always just been part of what we do.
Chris was one of the 1,000 workers at Hazelwood. At one point, he, his father and grandfather were working alongside one another.
It's real. You know, those boilers blew up, people were retrenched. It's real.
Chris knows change is coming as the community scrambles to build new industries and create jobs.
We're seeing this forced transition as we're seeing the criticality of the climate change issues that are occurring. And also simply the competition in terms of pricing on renewables and simply also the age of the stations.
Coal-fired power generation is the single largest source of greenhouse gases. At the Glasgow Climate Summit, more than 40 countries committed to phasing out coal in the next 3 decades. But Australia wasn't one of them. The clock is ticking.
Victoria's oldest and dirtiest coal-fired power station will be closed earlier than planned.
Plants have been shut and others will follow.
The region's gone into economic decline. The whole place is facing extinction, would be the best description.
4 decades after he started, Jeff Dyke is still a part of the 1,500-strong power workforce in the valley. The slumping cost of renewables are bringing the end of coal closer.
And so the question is, with their power industry expertise, is where do they go? What do they move into?
The Victorian state government has spent more than $250 million trying to find the answer.
There is a lot of interest locally and early investment into wind, solar, hydrogen, bioenergy, any sorts of energy production and setting the path for their own future.
But concerns remain. In a community scarred by the privatisation of the State Electricity Commission, the SEC, in the early 90s. There were 15,000 school students in the area then. Despite Victoria's mammoth population growth in the past 30 years, there are just over 11,000 students now.
I grew up near here and I've seen the pain of the transition to privatisation costing thousands of jobs. Communities here remember that and they don't want to see the same kind of carnage again. As the world moves away from fossil fuels, all they want is a viable plan to transition to a new kind of industry.
Are we seeing the acceptance of the inevitable? Yes, we are.
It was an age and we need to think about what's next.
At a time when next equals now.
Australia has refused to sign up to a global partnership to cut emissions of methane by 30% in the next decade. Australian miners have been setting their own targets to achieve a greener future. Rachel Papazzoni this time.
Australia's resources sector is responsible for about a third of our carbon emissions. some miners and energy companies are working to change that.
For the very first time, we've seen almost the entire planet rally around emission reductions.
Oz Minerals boss Andrew Cole wants his next mine to be carbon neutral. The copper and nickel project in remote Western Australia will be powered by its own renewable energy system.
The way that we are designing West Musgrave is to minimise emissions as much as we possibly can. So the base case there is to build a renewable energy farm.
The miner is also going to install less power-intensive equipment.
It's also difficult to retrofit existing operations with some of the technology that you need to actually make this journey. So it is easier to do on new operations which we're designing for.
Analysis by EY reveals for the first time, miners have ranked ESG and decarbonisation as the top two risks and opportunities they're facing as they head into 2022, which is why we're seeing companies like FMG start to reinvent themselves. Founder Andrew Forrest is reimagining what he started as an iron ore company nearly 20 years ago.
Our target is that people will see Fortescue as a different company. We will be a renewable and resources company, not just an iron ore mining company.
FMG is working toward carbon neutrality by 2030 and for its customers by 2040. Its subsidiary, FFI, is developing technologies to achieve that.
We've set up a centre in Hazelmere here in Perth where we've already demonstrated on a haul truck and a dual rig that we can use hydrogen, and we've also already put ammonia through a locomotive and testing it in ship cylinder engines as well.
New energy sources have also caught the eye of oil and gas producer Woodside. It's committing to build a $1 billion hydrogen and ammonia production facility in Perth.
We see a number of opportunities with customers both within Western Australia as well as overseas.
We're in a crisis, a climate crisis, and we need our largest emitting companies to really lead the transition.
Lobby groups have welcomed recent commitments but want to see more.
Start to invest quite heavily in reducing emissions, to reduce Scope 3 emissions across the longer term.
That's something BHP and Rio Tinto have pledged to do by 2050. Australia's biggest iron ore producer has now tripled its commitment to cut its Scope 1 and 2 carbon emissions, now committing to halve its carbon footprint by the end of this decade. To get there, it'll spend $10 billion, including switching to renewable power at its iron ore and aluminium operations and electrifying its mining equipment.
We're working with our partners, Caterpillar, Komatsu, to really develop the technology so that we can replace diesel trucks, probably with battery technologies, but potentially hydrogen as well.
Rio sees the potential for new revenue streams too.
I think it will open opportunities that we probably can't even imagine today in our own existing industries, but also, I guess, in adjacent industries as well.
While there's still much debate about targets, the resources sector is heading toward a greener future.
Australia is being warned if it doesn't cut carbon emissions faster, our exports could be taxed by other countries. Advocates want more incentives for investment in green technologies. Daniel Ziffer again.
A $170 million battery being built here on the edge of Melbourne will charge up from rooftop solar panels during the day.
And then discharge during that dinner time peak period.
But Alison Hawke says there's not enough policy certainty or incentives for businesses to invest.
The policy vacuum is slowing down the rate of transition, and greater policy certainty would help increase the rate of the investment in the industry, in what will be a very big industry with all kinds of businesses involved.
In a month, the world's attention will turn to Glasgow for the United Nations 26th Climate Change Conference. For our allies, the time for talk is over.
It is easy to be green. We have the technology. Code red for humanity.
After a decade of toxic politics, Australia will be turning up to COP26, promising far less than other developed countries.
But we're faffing about here in Australia. We need to recognise we've got carbon prices, we've got carbon markets. Let's put the political posturing aside, evolve and reform those markets.
If Australia doesn't put a price on carbon pollution, others may do it for us. The European Union is putting tariffs called the CBAMs on imports that haven't dealt with their emissions where they were created. That will hit our exports like steel and aluminium.
Increasingly, overseas investors are asking about the carbon content of production, and that's a trend that's only going to continue.
The federal government is already changing its tune on climate targets, following pressure from international allies and fears investors might withdraw from Australia.
We cannot run the risks that markets falsely assume that we are not transitioning in line with the rest of the world. Were we to find ourselves in that position, it would increase the cost of capital and reduce its availability.
There's great potential for Australia, but huge difficulties too. We're the second largest exporter of thermal coal, used for making energy, and we're the largest exporter of gas. The former head of the Australian Coal Association says we have to take action.
If we don't start to address climate change, the entire global financial system is under threat of collapse. What we do in the next 3 to 5 years is going to determine the future of humanity. And that's I think the seriousness of the situation we're actually in.
Net zero by 2050 means reducing our carbon emissions, the amount of pollution put into and taken out of the atmosphere, to nothing within 3 decades. In the next month, we'll hear that even that target won't be enough to stem irrevocable damage to our climate, and that if we don't cut faster, we risk a hotter planet and more extreme weather events.
We're sort of plodding along, sort of like, we're really just sort of picking ourselves up and getting moving, and we really need to be going at more of a Usain Bolt pace.
A sprint where the prize is everything.
Iron ore prices pulled back from record highs in May as China ramps up its commitment to reduce carbon emissions by cutting steel output following a global slowdown in manufacturing. What impact will the drop have on Australia's bottom line? Here's Rihanna Whitson.
It's the nation's biggest export. Iron ore is used by the world every year to build the cities we live in. And Australia is the world's biggest supplier. With miners BHP and Fortescue expected to follow Rio Tinto in delivering a record first half profit, the price of the commodity soared to a record high in May to more than $230 a tonne. Since then, it's fallen more than 30% to just over $160 a tonne, and it's now in a bear market. So what's behind this massive decline? Well, Brazil's firing back up its iron ore production after coronavirus disruptions and the Samarco dam disaster. But the big reason is China.
At the same time, we've seen the Chinese government once again try to clamp down on pollution levels, and obviously the steel manufacturers are one of the largest pollutants within their market.
Falling demand for our iron ore will hurt Australia's economy and our dollar. China buys 70% of the iron ore we export, and 60% of what they import comes from us.
And the Chinese also are looking at now developing projects themselves, such as the Simandou project. So we're seeing all of these factors come together, which is creating a little bit of a negative story for the iron ore market just at the moment.
Treasury assumes iron ore prices could fall to US $55 a tonne by the end of the March quarter. But if that happens sooner, nominal GDP could drop by $38 billion this financial year, and tax revenue by $8 billion.
This is a very volatile commodity, and so the earnings, so long as we track above the forecast, which looks very likely, anything additional is just bonus for the budget.
Not long ago, analysts were tipping a super cycle for the commodity. It's now looking like it could be a super bust.
As the uptake of electric vehicles soars, the demand for batteries is driving a rapid expansion of lithium mining. Already the biggest exporter in the world, Australia is in the driver's seat to capitalise on that demand. Existing miners are expanding and junior players are trying to get in on the action, as Rachel Papazoni reports.
A year ago, work at this lithium mine in Western Australia had slowed to about 30%. Now it's operating at full capacity, and it's in expansion mode.
The scale at Pilgangoora is really incredible. Very, very large resource and ultimately going to be a very large project.
Australia is the biggest producer of lithium in the world. The soft metal is found in spodumene rock formations and is a critical component for batteries, which are in high demand for electric vehicles and home storage systems. About 5,500 tonnes of ore is dug out of this pit every 24 hours and processed into spodumene concentrate. Pilbara Minerals hopes to ramp that up as demand for lithium soars. The miner recently bought the mine next door. Within months, it'll start digging out spodumene from there too. Once the ore's dug out of the ground, it's processed in the plant behind me, and 95% of it is exported to China. With both sites operating, Pilbara Minerals will export about 580,000 tonnes of spodumene concentrate from Port Hedland every year. It hopes to double that in the next couple of years. Analysts say the market will need it.
We do sort of struggle to find enough lithium to balance the market, particularly towards the end of the decade.
Increased demand for lithium has seen prices rise before. About 4 years ago, the market was paying more than $21,000 a tonne for lithium. But in 2018, prices started to plummet before bottoming out late last year.
They're now back over $10,000, sort of $11,000, $12,000, depending on which region you're in.
Miners aren't worried prices could crash again.
In the first wave, it was very much a China story. It's now become much more of a global story. And in fact, even today, European EV sales are rivaling, China EV sales.
250 kilometres south of Perth at Greenbushes is the largest known hard rock lithium reserve in the world. It's run by Talison Lithium, which is owned by a conglomerate of miners. The newest co-owner is IGO, having just signed a deal with Chinese miner Tianqi to take some of its share. Once a gold miner, IGO is repositioning itself as a batteries minerals producer.
We can see that clean energy future. We can see a future where there's a large penetration of electric vehicles across the planet, even Australia.
Australia has historically been a country that exports raw materials rather than turning them into physical objects like iron ore, which is made into steel in China. Lithium has so far been a bit the same, but that's about to change. Later this year, the IGO-Tianqi joint venture will become the first operation to export lithium hydroxide, processed right here at Kwinana, south of Perth. This step adds to the value chain, exporting a lithium compound that's been created out of the spodumene.
We need to be thinking now to make sure that in generations to come, we have a broad-based society that comprises downstream, comprises manufacturing.
This is a spodumene crystal.
Other miners want to keep more of the processing onshore too.
By value-adding the spodumene locally, there's a really strong opportunity for us to become a materially lower carbon footprint supply base in the lithium raw material supply chain.
Just like iron ore, Australia dominates the global export market. But there's no argument what will remain Australia's key commodity.
Not with iron ore the size it is. I mean, we're producing a billion tonnes a year effectively out of Western Australia.
Hayden Bairstow predicts global lithium demand will peak at just 0.1% of that. Adding another burgeoning industry to Australia's mining export dominance is good news for communities in mining and port regions.
You want the extra work to come.
Brewery owner Dan Scott says increased resources activity has a big impact on places like his town, Karratha.
What does make the town busier is from the last boom, it was a construction boom. So from that construction boom becomes a maintenance boom, because now all that extra infrastructure they've got to maintain.
Dan hopes lithium can become a commodity that's also part of the downstream processing chain in Australia, and maybe one day a battery manufacturer. If so, we could be looking toward a very bright future.
Cheers.
Over the past decade, Australia has become the world's biggest producer of liquefied natural gas. It's meant to be a way out of the nation's coal dilemma. But $300 billion later and pressure on energy giants to cut carbon emissions mean there are big questions about the future of the industry. Daniel Mercer reports.
Eleanor Short has seen firsthand the remarkable rise of Australia's LNG industry.
I reckon I can do that.
Yep, all right, thanks Cole.
With her husband Jamie, Eleanor runs an electrical contracting business in Chinchilla, west of Brisbane, servicing nearby coal seam gas wells.
When you go down the main street at lunchtime, you can't find a park, so town is busy.
From humble beginnings, the industry has grown to become an export powerhouse, and things don't seem to be slowing down. For the past 10 years, companies such as Shell and Origin have been funneling much of the gas north to processing plants at Gladstone, where it's loaded onto ships and sent to Asia. On the other side of the country, it's a similar story. There's been huge investments in LNG plants in response to surging worldwide demand for gas.
It's really been phenomenal. Over the last 10 to 15 years, the industry has invested over $200 billion US, which is about 300 billion Aussie, to build the industry to a point where we are now competing for the top slot globally as an LNG exporter. So it's Qatar and Australia. It's quite amazing.
On the back of the splurge, Woodside is aiming to build the $16 billion Scarborough LNG development off WA's north coast. But there are growing doubts about the prospects for Scarborough thanks to an extraordinary turn of events last month. Within hours, Woodside's partners and global oil majors Shell, Chevron and ExxonMobil were hit with strikes from investors demanding greater action to cut pollution. It came as the International Energy Agency argued no new oil and gas project should be built if the world is to meet the Paris climate commitments. Despite the upheaval, Woodside says the case for Scarborough is strong.
The reservoir has almost no CO2. The train that we propose to build at the Pluto site will be very low emissions intensity. So the product that we're going to offer to customers in Asia will be low cost and low carbon.
But critics say investors have their doubts.
Share price has halved over the last 10 years, but this project, I guess, is seen as the last hurrah. And I guess there are other options, but the problem is that Woodside isn't looking at them. It's too focused on Scarborough.
Pressure has been building on the LNG industry for years. Soaring East Coast gas prices have seen local users pay more for gas than foreign customers. What's more, billions have been written off Queensland's LNG plants with claims there's not enough gas to feed them. At the same time, cost blowouts on many new projects mean it's unlikely taxpayers will see an economic return on the investments for decades, if at all.
We saw write-downs across the industry, including Santos, Woodside and Origin. So they're in a bit of a state of flux at the moment.
While uncertainty about the fate of Scarborough lingers, industry experts say the longer-term trends seem to be clear. They say that even if Scarborough gets up, it's likely to be the last of its kind.
What I don't expect to see is another Gorgon or another Wheatstone. I don't think there's any appetite amongst the Australian producers to invest in a new greenfield LNG project at the moment.
Back in Chinchilla, Jamie Short isn't afraid of change and thinks it'll be some time coming.
We can pretty much sort of roll into any type of new process like hydrogen or solar. We're pretty versatile in that respect. Electrical's electrical. It's not, you can do it anywhere.
Unlike Australia's gas giants.
Rare earths are set to play a big part in technologies from electric vehicles to wind turbines. But with relations between the West and the world's biggest supplier, China, at a low point, efforts to diversify supply have prompted renewed interest in Australia's huge deposits.
Rare earths power this hybrid electric car. And for Australia's fledgling rare earths industry, the race is just getting started. The minerals are relatively unknown, but are set to play a big part in the 21st century economy.
You got up this morning, you picked up your phone, you got in your car, maybe you drove past a wind turbine. In all of these devices, you find rare earths.
Australia is the world's second biggest supplier of the commodities, but China dominates the trade, accounting for up to 80% of global production. With tensions escalating between Beijing and Washington, concerns are growing about China's stranglehold of the market.
We think it's risky to put all your eggs in one basket. That's why it's important to have a diversified, resilient and responsible supply chain for rare earths.
Others are blunter in their assessment. They warn the control of rare earths gives China an economic weapon to use against countries in their fight against problems, ranging from climate change to foreign threats.
It's cut off supply of rare earths in the past, to Japan in 2010, and of late there's been a number of threats made that it might cut off supply to the United States in the future.
The dominance of China in the rare earths industry is fueling calls for the development of alternative supplies for technologies including wind turbines like these. That's put the spotlight firmly on Australia, which has much of the world's known rare earths reserves.
Western Australia has enough in the ground to supply the world for hundreds of years. The big challenge is changing the equation for businesses in the resources and chemical sectors to make it cost effective for them to both mine and process and produce these rare metals.
Despite the calls, Lynas says new Australian entrants will struggle to compete with firms from China, which are heavily backed by the state.
Rare earths are not for the faint-hearted. 30 years ago, the Chinese recognised the value and importance of rare earths and set about really developing not just their resource strategy, but also their downstream industrial strategy.
It's a risk acknowledged by the Biden administration, which commissioned a report that found greater involvement from Washington was needed to secure critical mineral supply chains. In February, the US government awarded $40 million to Lynas to build a rare earths processing plant in Texas.
It is certainly a top priority of both of our governments as we look at making these responsible, transparent, diversified supply chains.
Lynas's Amanda Lakay says the funding will help level the playing field against Chinese companies, but more assistance will be needed if Australia wants to take advantage of its huge reserves.
The issue of the distortion of the market by having such a dominant position from China, for us to be successful in Australia, probably will require some intervention or support from government.
A call for government action as trade tensions continue to escalate.
And that's all from this summer special on resources. For more on those stories, you can go to our website or jump onto ABC iView. I'm Alicia Barry. Thanks for watching.